So today, as I said, the Bloomberg trading competition starts. So for each of your team leaders, they can go to either idea or team message to get to the screen, click on the drop down, select the network, UMG, BMGT 443, fall 19, your section. This is section 201. Okay. Then once you start trading, you'll see the teams that are in this section that will start to list. Okay. So here's the basic premise. You'll start today with $1 million hypothetical dollars. You can trade equities, disabled everything else, right? You'll basically be judged in 6 weeks. There are 6 teams in this section, so you're going to be competing only against the teams that are registered for your section. In 6 weeks, the team with the highest portfolio value gets 5 points. Second and third place get 4 points. Fourth place gets 3 points. Fifth place, 2 points. Last place, 1 point. We'll then continue trading until the end of the semester. Last week of class, we'll again score you on relative portfolio value, 5, 4, 4, 3, 2, 1. Okay, so basically that's it. You can go long in equities or you can sell short, but a couple of major restrictions. Number one, each half of the semester, you must go a minimum of 10 longs. I don't care how many shorts you do. I don't care how much you sell, but you have to buy 10 different stocks each half of the semester. And if you buy 50 of them in the first half of the semester, you still have to buy an additional 10 longs in the second half of the semester. Okay? Shorting a stock and covering it doesn't count. So you can short as much as you want. That doesn't count towards the competition in terms of the amount of trades you have to make. Minimum trades are 10 longs. Do as much shorting as you want. Okay? Now, second part, you must, starting 1 week from today, be a minimum of 70% in equity, no more than 30% cash at any point for the rest of the semester. At any point in time, if you're more than 30% in cash, your team will be disqualified for the semester and you'll get a 0 for the rest of the semester on both parts of the semester. So this is a trading competition. You have to trade. I don't care how miserable the market is. I don't care what crazy crap our president starts tweeting about. You have to continue to trade regardless of the market conditions. Okay? So if the market goes down, just lose less, right? Or start shorting stocks. But nonetheless, 70% at all times starting next Monday in equity, which means if you sell something, it should have a corresponding buy to put it in that stock. Now, again, I'm not going to be too ticky-tack in that if you're in cash for 24 hours, I'm not going to disqualify you, but I'm just being serious. You can't sit in cash this semester. You must trade. Yes?
So if we're moving from one position, though, to like another one, is it fine if it like goes down to under?
As I said, if it's like one day, I'm not going to hold it against you. But if it's a week and you're sitting in a bunch of cash, then I'm going to basically have a very harsh conversation with your team. It's the spirit of what I'm talking about. Okay, so I want you to trade, right? So where are the rules? If you click on settings, this is now only the person that's registered can do this. Click on rules. These are some of the basic rules. Now, what you're actually doing is you're getting access to the full Bloomberg trading platform, but 2 things. One, it's not real dollars. Maryland will not let you do that. And 2, it's actually got some limitations that I put on it. Okay, so let me talk to you about some of the limitations. First limitation, you're going to do all trading at market prices based on the next tick. So I've eliminated the ability to do limit orders or stop loss orders. You can do it, but I'm not going to let you do it in this class. That's why the person who's responsible for your team is so critical. Because let's say Apple has their earnings announcement tomorrow and bad news comes out and you got a big position in Apple, that you keep owning that stock until somebody goes in and actually trades it. There's no auto trading set up in the system. Okay, so you buy, you sell through your portfolio manager. Yes. You can only trade through the terminals. You have to physically be at a terminal to trade. Okay. Next, I used to do write-ups where I'd make you write up the rationale for the trades. That was part of your grade, but I've simplified it. So every trade requires a minimum 50-character write-up. That's like 40% of a tweet, right? So it shouldn't be that hard to give your business rationale for buying the stock, right? And your business rationale isn't, oh, I really like to shop at Best Buy, it's convenient. No, that's not why you're buying or selling Best Buy. Okay? It should be, hey, Best Buy is reporting earnings. I think they're going to exceed their expectations. Like some business rationale for why you are making that trade. You have to do that for every buy, every sell. It won't let you complete the trade without typing it in. In fact, the nice thing about the rules is the rules are set up that the trade won't go through if you trip one of the rules. It'll tell you what rule you're tripping. If the trade goes through, then you can make it. Stocks, ETFs are okay. Everything else disabled. Okay. Next, auto closing. In Bloomberg parlance, buying a stock is called an idea, and selling a stock is called closing the idea. Okay. So that's what they call it. I didn't make those names up. Okay. So I've disallowed auto closing of ideas, which means you have to go in and manually sell the stock. You have to go in and cover the short. It's not going to auto do it. Okay? In terms of investment levels, the minimum that you can put into a stock is $10,000. You're starting with $1 million. If you're going to invest anything less than $10,000, it's pretty trivial. The maximum is 20% of your portfolio at that time. So right now you're at $1 million. The most you can put in a stock is $200,000. Okay. So if you go over, like let's say your stock shoots up, you don't have to sell it. It's just the most that you can buy at the time that you acquire the stock. In terms of the restrictions, one of the restrictions I've done is I've limited you to major markets. So if you trade in the U.S., if you trade in London, you trade in Frankfurt, trade in Hong Kong, all that okay. Shanghai, no. Okay. Certain markets, Tel Aviv, I don't think I said. New Delhi, I don't think you can trade. So it has to be pretty much a major market. Again, same idea. If you find the stock and it lets it go through, you're okay. Okay. Next, trading limits. Minimum market cap is 500,000. Okay. So you can't find the next biotech that's about to do an IPO. It won't let you trade that. 500,000 is the minimum market cap. And the minimum price is $3. No trading in penny stocks. Okay? So if the stock's trading at 30 cents a share, can't buy it for this competition. You buy a stock at $3 and it goes down to 30 cents a share, you can sell it, but you can't buy it again. Same thing with shorting. You can't short a stock that's below $3. There'll just be an enforced limit throughout the competition. Okay? Trading restrictions. Bloomberg allows day trading. I do not. Anything you buy today, you must hold for at least one day, one trading day. Okay. So basically, it's going to actually try and execute it. So for example, if you bought a stock right now, before 4 p.m. Eastern Standard Time in the U.S., it would probably execute today. It takes about 10 minutes to execute a trade in Bloomberg. And then the earliest you could sell it would be tomorrow. So if I bought it today, I can't sell it today. I'd have to wait till the next business day. It also does not allow for after-hours trading. So it would be the next market opening day. And it's enforced by time of day. So for example, you trade in London, like I think right now the market is about to be closed. So you'd have to wait until tomorrow in order for the market to be open to buy a stock, even if you said buy it today on the FTSE. Okay. Next. Your cost per trading is 1 penny a share, which is pretty common for what institutions pay. So you buy 10,000 shares of stock, it's going to cost you $100. Okay, so it's pretty trivial in terms of your actual trading costs, but nonetheless, penny a share for trading costs. And the other thing that you got to be aware of is, as I said, everything is done at the next tick, which means it's going to be market prices. Now, when I say market prices, Bloomberg is actually going to fill it based on actual trading. So what it's going to do, if I want to buy a stock, it's going to go look at the actual bid asks and fill based on actual bid asks. And this is important because if you stay with big companies, Apple, Google, Union Pacific, you're not going to have any trouble. But we actually had this happen where somebody bought this tiny company that nobody ever heard of, and it wouldn't actually allow it to go through. The trade just sat there forever. And we finally called Bloomberg, and Bloomberg's like, look, there aren't enough shares in the real world to actually execute the trade. So it wasn't that Bloomberg wouldn't let it do it. It's just for the volume they wanted, they couldn't buy it. And then when they finally bought it, they couldn't sell it because there was nobody willing to buy it. Okay, so I'm just letting you know it's going to use actual bid asks. to sell and buy your stock. And for some of those thinly traded stocks, those bid-ask spreads could be pretty big. Just FYI, be warned about that. So how do you actually trade? Let's come over here. So to trade, hit compose. It'll bring up a screen that looks like this. You can go long, you can go short. To be honest with you, I don't even know what pairing does. So long or short. Type in your ticker. So let's say, hey, Apple's about to do an earnings announcement tomorrow, so I'll buy some Apple today. I'm going to go long. Importance doesn't matter. Target price doesn't matter. Horizon doesn't matter. Apple right now is trading at $214 per share. So basically what I'm going to do, now I have more than one section I'm registered for, so you'll only have one network is what it's called. So for this section, I am in fall 19201. And then it's going to trade the next tick. It won't let you do limit orders. And then you put in the dollar amount of the shares. You don't have to put in the amount of shares. And then Bloomberg will just figure out how many shares. So if I wanted to do 200,000, I could either type in 200,000 or 200K. And then basically hit send to submit. And then if I trip any rules, it'll pop up. The rule that tripped up is I didn't put in my 50 characters. So cancel, put in Apple is about to do a new product launch which will surprise investors. Okay, send, done. Take about 5 to 10 minutes. Okay, do one more. So again, I'm going to compose. I'm going to buy, go long. I'm going to buy, what am I going to buy this time? This is fall 19. So I'm going to buy, instead of Union Pacific, I'm going to buy Square. And I'm going to put 200,000 more dollars into Square. And I'm going to say this payment company should do well in the upcoming holiday season. SME market. All right, so I'm putting in my two longs. And again, when the trade's complete, I can click on my name and it will show me my portfolio. Now these haven't actually gone through. Now I'm going to click here just to go to an earlier class. So in an earlier class, you can see I made two choices earlier today. I'm already down. So I lost money on Square and Lockheed Martin today. I think the market's probably down today. But the point is, how you're going to be judged is based on your P&L and your absolute return. Okay, so essentially in 6 weeks, don't care in the interim, in 6 weeks, I'm going to see all the teams. We're going to rank you from highest to lowest. I don't count because I'm not going to do more of these two trades. I'm going to be disqualified by design. But nonetheless, you're going to trade, and then whoever has the highest portfolio value, the lowest portfolio value, not risk-adjusted rank. Okay. Last but not least, if you want to sell your stock, it's kind of odd, but when you're looking at your screen, click on the circle red X. That's called closing the idea, and that's how you sell the stock. Now, just a word, when you close the idea, it sells all of the stock. So if I bought 200,000 of Apple, when I close Apple, it sells 200,000 of Apple. It doesn't let me sell part of Apple. So for some reason, I thought, well, I'm going to buy some Apple and then sell others, make two trades. Apple 100K, Apple 100K. That way, if I want to sell half later, I could sell half later. I can sell all of it and rebuy it back, but either way, when you close, it closes all of it, doesn't close some of it. Okay? And again, it won't let you close until the next business day. So even though I bought it today, it's not going to let me close the idea until tomorrow. Okay, questions about this? Yes?
Is there any way to see how the other teams are doing compared to you?
So what should happen, because I'm the administrator, is you'll see the teams as they start coming on here. The difference is, instead of seeing this guy's name, C Ferrara, you'll just see a bunch of X's. So you'll see the team, but you won't actually see their names and you won't see what they've traded. You'll just see their portfolio values. Right? So that's called the trading competition. Go make some money. All right. So a few other things we got to cover today. So first, group project 1. Hopefully everybody submitted that without problems. I want to talk about homework 1 and 2. Homework 1 should have been pretty simple. Okay. So you took the right screenshot for Union Pacific, which if I went to UNP, US Equity, RV, and essentially custom went to our spread template, you should have a screenshot look something like this. Okay? And again, the wax might be a little different, but your ROIC should be this. Right? And so the first question was, does the railroad industry is an attractive industry? What would the answer be? Yes, because 12.45 is greater than 7.76, basically. Had to use the numbers, had a positive spread. Does Union Pacific have competitive advantage? Yes, because their spread of 13.17 minus 763 is greater than 12.45 minus 7.76. Write that, hit the minimum word count, put your screenshot, easy peasy. Okay, that was homework 1. Hopefully pretty straightforward. Okay, most important thing to homework 1 is, can you actually use the terminal, get the data, do you know what you're looking at, kind of following some general directions for the class. We're going to build on this in homework 3. Okay, homework 2, again, relatively simple from my perspective because I pretty much did homework 2 in class. It's on the video. So if you did the key value driver spreadsheet and you referred to numbers along the way and wrote it up, these were the 4 scenarios we actually covered in the lecture. Okay, so the first scenario is if you have a positive spread and you increase your G, what happens to value in PE? It should go up, and you could even use the numbers in your spreadsheet, right? Because basically you're increasing value at a faster rate. What happens in scenario 2 if you have a negative spread and you increase your G, but the value in the PE go down? And again, you could have used some numbers for examples in there, right? And I didn't say this explicitly in the lecture, but I'll say it explicitly now. Growth does not create value, right? And that's actually one of the fundamental things that you're going to start to understand this semester that people don't completely understand in the real world. It's because the bias in the real world is growth is the key to value creation, right? And I'm not saying that growth is not important, but growth is the accelerant to value creation. It's the growth spread combination that's eventually going to matter. Okay, so again, this is what this exercise illustrates. If you got a positive spread, grow it, create value more exponentially. Have a negative spread, grow it, destroy value more exponentially. Okay, scenario number 3, ROIC equals WACC. What happens when you increase your G? Yeah, nothing. This is the treadmill, right? So you do a bunch of 0 NPV projects, you end up with 0 NPV. So it creates no value. Okay, and in scenario number 4, you have a positive spread, but your G starts going down. So what's going to happen there? I'm sorry?
The value decreases.
Yeah, you're going to show illustration of a value decreasing. Because this is the expectation cornerstone. I price you as if you use the example, you make 20% ROIC, you grow that at 1.05 to the whatever power, right? I realize I was too optimistic. You make 20%, and now I'm only going to grow at 1.03 to whatever power. It's just going to be worth less. So you're going to be worth less because I have to reprice you at a lower rate. Yes, sir.
How do you, from a conceptual perspective, what happens if your ROIC is less than the WACC, but you were able to gain a higher market share, and then you set up a future like Amazon? What do you,
Well,
how do you
the key is, and this is what we're going to have to do, is that it's not about market share. It's what is going to be that long-term spread. Because if Amazon, let's just say the presumption of your question is Amazon has a negative spread, which right now actually is slightly positive spread. But if Amazon were to have a negative spread, and I don't think they ever turn it into a positive spread. Doesn't matter what the growth is. You want to see that in action? Look at Wall Street's reaction to WeWork, right? The problem with WeWork was actually, I saw a guy on CNBC, he couldn't have said it more clearly. They have $47 billion of long-term leases at WeWork that are on their books for the next decades, right? And they're losing 50 cents on every dollar on every lease today. So I don't know how you come up with whatever crazy valuation with all the other stuff that they threw into their weird corporate governance practices. But the point of the story is the only way you get to 20 billion is first they have to have positive cash flow in their leases, which they've never done. And then they have to make sure they cover all those liabilities, which they don't have. WeWork is the whole idea of you can sign up by a month and quit at any time, yet they're on the hook for real estate for decades. So essentially the guy said they're like a savings and loan, right? That was actually where savings and loan got in trouble because they mismatched long-term liabilities with short-term assets. We go into recession, WeWork's going to get crushed, right? And I think that's what Wall Street's really worried about right now. But that's a separate story. But the point of the story is, in order to be a positive valuation, to get the 20 billion that they want in their decreased IPO, I have to believe that that spread's going to eventually turn positive. If I don't, they're worthless. So that's what the math tells me. And so the point is, this is perpetuity. So these formulas are perpetuity formulas. It's what it's going to be in the long term, not what it is in third quarter 2019. That's the other thing we're going to start working on over time. Other questions? All right, so let's talk about homework 3. So I posted lecture 2 this morning, which is on EIC, and homework 3 will be based on EIC. So I'll give you a minute to pop up this file if you wanted to follow along. All right, so the general idea of EIC, and EIC is a framework where E stands for economy, I stands for industry, and C stands for company, kind of like a reverse pyramid, but it's a way of analyzing. Basically, the question that you're analyzing is, how does the external environment impact the industry and the company I'm analyzing? So it's just a framework to have that conversation, okay? So we'll start at the top of the pyramid, which is the economy. And again, the basic premise of the question we're asking is, what's going to happen to the economy? And for the industry and the company that we're analyzing, does that matter? Okay, so how sensitive is our company and industry to changes in the economic conditions? What is that macroeconomic environment? That's really what we're trying to do with the E part of the EIC. So for simplicity, you can see this on here. When we do economic analysis, these were the two questions. So what's happened in the economy, and does it matter to our company? To get the answer, this is why, as part of your Bloomberg certification, you looked at economic data. And there's two screens we're going to use, ECFC, ECSU as a starting point. Now think of this as minimum. You can use more screens than this, but this is the minimum that we're going to look at for homework 3. So I'll go back to Bloomberg. ECFC, economic forecasts. So just as Bloomberg is surveying sell-side analysts to predict the earnings of companies, Bloomberg is also surveying economists to predict what's going to happen with economic data for countries. Okay, so this defaults to the US, the region, and you can see historical data and forecast data, but you got GDP, you got CPI, you have housing, labor, external, budget deficits, interest rates, exchange rates, etc. Okay, so you can see that for GDP, 2019, right now, the market is expecting 2.3% GDP growth in the US. In 19, 1.8% in 2020, 1.8% in 2021. As of today, 35% probability of recession. I want to point out that this is September 2019. In May, it was 20%. Matter of fact, 2 weeks ago when we started this class, it was 30%, and today it's 35% and rising. I think it's rising by the tweet. Okay, so did you see that JP Morgan has the tweet index? Yeah, the Feifei index. I mean, this is like a comedy. I'm wondering when we're going to wake up.
Is
But
that
that's
valid for the trading game?
What? The
index?
Feifei index?
Yeah.
I don't. If they put an ETF on it, you can buy the ETF. Play Donald's nightmare. All right. So probability of recession is 35%. Again, that's just 1 in 3. I mean, that's just the world that we live in right now. I mean, people are looking at inverted yield curves. They're looking at what's going on with exchange rates. They're looking at all the impacts of these tariffs. And right now, people are a little bit nervous. But nonetheless, this is something we should start to care about. By the way, if you want to see the UK, who's even more screwed up than we are, here's the United Kingdom. They only have a 31.5% chance of recession, which I find to be ironic, with Brexit coming up in 45 days. But in any event, you can see that there's at least tepid growth for the UK, a little bit less than the US, but you can look at it by market. In fact, you can look at China. Anything under 6% is considered recession for China right now, just because they need the growth to sustain. And you can see that China's growth is projected to go below 6%. So again, all these trade things are really bad for the entire world. And nonetheless, here's some data on what the forecasts are. Not saying the forecasts are right or wrong, but these are what the pros are basically saying. So if the economic conditions are worsening, then the next question is, and I'll use Union Pacific by proxy, how's it going to affect my railroad industry? How's it going to affect my railroad that I'm analyzing? Okay, so then I'll go to my company, UNP, US Equity, and I'll go to the RV screen, and then I will go to the markets, and then I'll go to the beta tab. So here's where we're going to bring out the transitive property. A equals B, B equals C, therefore A equals C. So the idea is, in the market conditions, a rising tide will rise all boats. So if the market's getting better, then the companies in those markets should do better and the market should go up. A falling tide hurts all boats. Market's going down, then the economy's going down, the markets are going to probably go down with them. Okay? So the first part is what's happening. So we're looking at the economic forecast. By the way, the second screen we're going to look at is called the Economic Surprise Index, ECSU, because this is the other thing that's going to impact us in the short term, which is basically not just what is the economy, but how is the economy doing against expectations. Okay, so starting with the Great Recession, Bloomberg started tracking this data. So on the left, we have 43 economic statistics that are being forecast by various economic groups. They're aggregating them here in one place. And they put them into 6 categories or buckets. So housing and real estate, industrial, labor, personal household income, retail wholesale, and then the surveys, like consumer confidence, stuff like that. So basically, these are the actual forecasts that are being made. And then what Bloomberg does, and when the data comes out, it shows whether there was a surprise, actual versus consensus, and what happened to the market that day when that economic data was actually released to the underlying market index in the US, the S&P 500. So for example, for pending home sales, which came out on 29 August, it came out down 2.5%. That was a negative 4.63% surprise. The S&P 500 went down that day. Okay, so again, Bloomberg is just giving us data. This is actually why I think people are worried about recession right now, because 4 of the 6 buckets are flashing red, which basically means that the economic data that people are forecasting is coming out much worse than what is expected. The only thing that right now is coming out better than is expected is we're still spending money on our credit cards. All right? So we're still buying stuff, but outside of that, everything else is looking kind of bad. Right? So again, this is 10 years of historical data, which you can make bigger, but the general idea here is that this line here, the orange line, is the S&P 500 index, and the white line is the economic surprise index, which is the average of all 43 with an algorithm. So generally, historically, when we had negative surprises, worse than expected economic news, the market goes down. Better than expected economic news, the market goes up. And that's been working pretty well for 10 years until now. Right now, we're actually seeing an opposite effect. That the worse the economy is doing on news, the better the market has been doing. Okay? Now, to me, that looks suspicious. Right? And so right now, I'm just saying that there's trading opportunity here because this is not normal. Matter of fact, we're in an inverted yield curve area, which is not normal. We're in a negative interest rate environment in some parts of the world, which is not normal. So I got some stuff to figure out. But nonetheless, what do we think is going to happen to the economy? It's going to start to matter. Because right now, a lot of bad news seems to be coming out much worse than expected. So again, does that translate as that could impact the railroads? So I go back to RV, if that's my company, for Union Pacific. Markets, beta. So here's what we know about beta. The market cap weighted average beta, the raw beta, 1.05. So what's that mean? If the U.S. rail beta is 1.05, what does that mean? Oh, this is what you're going to have to do in homework 3. So good practice. Is the rail sensitive? Are the rails sensitive? Yeah.
It's slightly more sensitive than the market.
Yeah. So it means that the market goes up, the rails go up. Markets goes down, the rails go down. They're going up and down with the market. Actually, it's the other way around. In the real world, the rails are actually one of the leading indicators the markets look at. Because if they start carrying a lot less agricultural goods, means people are buying less food. They carry a lot less oil, and people are using less oil. That's going to be bad for oil prices. So in a way, the rails are actually telling you what's happening to the economy because they're going right up and down with the economy. That's the beta of 1.05. Okay? And then the company, Union Pacific, they're no different than any other rail. Their beta is 1. Industry is 1.05. They're both going up and down with the economy. Union Pacific a little less, but that's not too statistically insignificant. All right, everybody get that part? All right, now in Bloomberg, you'll see a raw beta and an adjusted beta. Okay, for purposes of this class, for the E, we're going to use raw. That's just Professor Perfetti's rule. Okay, so how does Bloomberg estimate beta? You can actually type in beta. So what they're doing is they're doing a scatter plot diagram where they take 2 years worth of data by default, quarterly, and weekly, 2 years of weekly data, and they take the performance of Union Pacific on a weekly basis, the performance of the S&P 500 on a weekly basis, put in the plots for basically 104 data plots, right? Draw a trend line. Slope of that line is your raw beta. Okay, that's how they're getting the Union Pacific beta. Right? Now, to get to the adjusted beta, that just goes back to statisticians believe in essentially normalized curves, so they put in a smoothing coefficient. So the raw beta is the slope of the line. The adjusted beta is 2/3 of the raw and 1/3 of 1. So the adjusted just moves the raw beta 1/3 closer to the mean. That's all it is. Okay. Now, when Bloomberg does CAPM, it uses adjusted by default. Okay, but for our purposes, for E, I want to use raw because what I'm trying to assess is how sensitive is the S&P, how sensitive is Union Pacific and the rails to the S&P. So I care about the actual sensitivity. I'm not smoothing it out over time. Okay, that's just my choice for the semester. You can make a different choice in another class, but just so we're all consistent for this semester. Make sense? Okay. So that's the E. That's part of your homework assignment for your E. Questions about the E? Okay. The only difference is for homework 3, you're going to do this on United Airlines. Okay. UAL, U.S. Equity. Okay. Next, I. I is industry. So you started this with homework 1 with the rails. You went to the RV screen. You created a custom RV called spread, or whatever you called it, where you had the ROIC of the latest filing against the WACC. custom. And this is what we went over for homework 1. And we said that this was an attractive industry because it had a positive spread. And Union Pacific appeared to have some competitive advantage because it had a slightly more positive spread. Use numbers. Don't generalize. Yes?
For other industries, when we do this, does it matter like what region and what source we use?
Yes, it does.
Okay.
So for this assignment, you're going to use U.S. Airlines. Use the default.
The default's okay.
Default's okay. So here's the deal. When you do this assignment, the difference between homework 1 and homework 3 is homework 1, you just did the data says it's good or the data says it's bad, right? In homework 3, I want to know why. Okay, so here's what's new. Did you guys do Porter 5 forces in a previous class? If you didn't, look it up. Okay, but basically Porter 5 forces is a framework to explain the industry. So here's the deal. What I want you to do, and I'll give you a hint, it is likely that the airlines have a positive spread. Just guessing, but I think it's a pretty good guess. And you're going to use actual numbers and give me an actual screenshot of that. Okay? So, why? Using the Porter 5 forces, barriers to entry and exit, substitutes, rivalry, buyer power, supplier power. Going through those 5 forces, you have to explain the spread. Okay? That's going to be key to your assignment. Now, I'm going to put an asterisk on this to try and be helpful. You have to check your biases at the door. Right? It's not what you think is the competitive advantage. It's not what you think the industry is. It's you start with the data, and then you explain the data that you see. I was teaching an MBA version of this class a couple years ago, and I had a student. I felt bad for him. He couldn't get past the fact that when we did the airline industry, that in his mind, the airline industry sucked. He kept quoting me that Warren Buffett had a quote that once said, the fastest way to make $1 million in the airline industry is to spend $1 billion. He talked to me about the Southwest airline case he did with Harvard. He talked to me about all the historically bad data that the airlines have done. Well, guess what? That's not the airline industry today. In fact, Delta Airlines' largest investor is Warren Buffett. Okay, so what I'm telling you is people change their minds. The industry can change over time. So when you talk this semester, or for that matter in life, it's not that I like or hate an industry. It's what does the data say? And if the data says it's attractive, we got to explain it. And if the data says it's unattractive, we have to explain it. So the 5 forces needs to explain what you see. And that's just going to be very important for your assignment. So if you give an inconsistent 5 forces, meaning, hey, it has a positive spread, but you know what? The buyers have all the power. Suppliers have all the power. It's easy to get in and out of this industry. It's an awful industry for substitutes, yada, yada. Well, that doesn't explain why it has a positive spread. Okay, so again, explain based on what you see. So that's the first part. What is the spread and why is the spread using the 5 forces? Then, get out your binoculars. Get out your crystal ball. Tell me what that's going to look like in 5 years. I want to know what the spread's going to be in 5 years. Same, higher, lower. And here's how you're going to do this. You're going to tell me if the 5 forces are going to change. So you're going to do the 5 forces today, and you're going to do the 5 forces in 5 years. If nothing changes about those forces in 5 years, then the spread's going to be about the same. If the 5 forces get more favorable in 5 years, then the spread should go up. And if the 5 forces get less favorable, the spread should go down. So for the I, for the E, we already talked about, for the I, you're going to give me the screenshot of the spread for United against the industry. You're going to tell me whether it's an attractive industry, and you're going to explain today using the 5 forces, and you're going to make a forecast of what you think those 5 forces are going to be in the future to infer what should happen to the spread in the future. Questions? Now, I don't expect that you know a lot about airlines, and that's okay. And so you're going to use real-world information to answer a very real-world question. So, for example, one of the things you might do, if I did airlines, so I'm using Rails as a proxy, is I can go to BICO, And here is all the industry summarized analyst reports for the railroad industry. Airlines are the same thing. I could also go to BI in general, which is Bloomberg Intelligence. This is why you're getting certified. And this is the industry dashboard with lots of data about the industry. I can also go to Elms, and right off the course website is a link to VBIC. And in VBIC, these are the subscriptions the school has for various data services. If I go to the industry subscription, there's a data service called IBIS World that the school subscribes to. And IBIS World basically writes industry analysis reports for a living. So you can type in United Airlines or the airlines, do a search, and you'll see the industry report for the U.S. Airlines, which, by the way, contains a 5 forces analysis. All right. So what I'm telling you, and I'll be really clear, is that in this class, we're trying to answer real-world questions. It's perfectly okay to use real-world data to supplement your opinion. Just don't plagiarize. So source. So if you use the IBIS report, source the IBIS report. If you use BICO, source the BICO. Okay. If you cut and paste a paragraph, put quotes around it and footnote it. Right? Because you're going to be running through Turnitin. And if you cut and paste a paragraph and Turnitin says you plagiarize it, you don't have a footnote or bibliography, it's going to be really ugly for you. So don't plagiarize, but it's perfectly okay to use it so long as you source. Okay? Now again, somebody asked, like, what specific footnote type do I need? I'll be very clear. I don't really care as long as it's footnoted. Like, just make it so I understand that this is sourced from somebody else and here's who it's attributed to so I know it's not your own work. All right? Because this is going to be just very important in real life. Because in the real world, you're going to be sourcing stuff all the time, and you always want to give attribution, because if nothing else, I need to know what source you're getting it from to know how reliable it is. Because some sources might be actually more reliable than others. But if nothing else, this is an academic class. So again, you're welcome to help you source this thing, but regardless, make sure that you actually refer to whatever your sources are. Okay? That's the I part of the EIC. Questions about the I? Okay. The final one is the C, which is the company itself. Does United Airlines, does Union Pacific have competitive advantage? And the short answer is we believed it did. There's the 5 forces. Because we said that it was outperforming its peers on spread. So here's the next question. Why? Right? Why is Union Pacific doing better than the rest of its peers? So give me some text associated with that. So again, here's the key. If you're doing United, and let's say United has a competitive advantage, does not have a competitive advantage because they don't have the spread of the industry, and you start talking about their great routes out of San Francisco and what makes them a great airline, you're going to get a 0 for that part of the paper. It's got to be in sync with what you see. So the key is, when you do the EI and the C, that the data should support whether it's an attractive industry, whether the company has competitive advantage, and then the narrative should support the data. Okay? So that's the way that you should be thinking about doing this assignment. Okay? 500 words, individual assignment, due Monday, 10 a.m. It's a page and a half. So it shouldn't be that hard. You're welcome to use these sources to help you do it, but this is kind of taking assignment 1, going a little further. We're going to practice with the airlines. Something you should be somewhat familiar with. Okay? Questions about that? So the good news for you is Wednesday, no class. Okay, so there's no lecture on Wednesday, because I know I gave you a lot to do at the beginning of the semester, including your Bloomberg certification, which is due end of day Friday. So you need to finish your Bloomberg certification by midnight Friday. Okay? Individual homework 3 is due Monday, 10 a.m. Make sure you submit that. And today is the start of the Bloomberg Trading Challenge. Okay? So basically, you don't have to trade starting today, but by next Monday, you need to be 70% invested in the marketplace and make 10 total longs over the 6 weeks coming up. Yes, sir. For homework 3, I'll put it on the screen, which is on the video. If I'm doing UAL, and I am going to RV, And I won't go to the custom tab, but I'll go to like the comp sheets tab. The one you should be using for United should be the analyst curated BIs, because those are the US ones. It'll be the same one in the custom tab. This cuts all across the tabs. Basically, it's the big US airlines. Okay? Yes, sir.
I have a question about this Bloomberg certification. You said there's 5 sections, right?
So again, if I go to BMC for Bloomberg certification, if you go to course modules, economic indicators, currencies, fixed income, equity, portfolio management. Those are the 5 sections. They changed it this year. If you did Bloomberg certification in the spring or last year, you only had 4 sections to get the certificate. Starting this summer, they added portfolio management, section number 5. So when you send me the certificate, if you send me a certificate because you took it in the spring, you still have to show me all 5 sections, which means you'd have to take the 5th section and show me more than 70% on portfolio management. Those are the 5 sections. There's no grade for getting started in the terminal, but there is a grade for portfolio management. You must be 70% or better on every one of those sections. Somebody in the 11 a.m. section came up to me and showed me his thing. He said 4 of the 5 were above 71, and the average of all 5 was above 71. I said, no, you still have to retake that other section. Right? Now, when you retake it, you only have to take that one section again. So you have to create another account, not a Bloomberg account, but another BMC account, go to that one section and retake it. So you give me 2 screenshots. Here's a screenshot with 4 of the 5 above 70%. Here's a screenshot with the missing one above 70%. And here is my certificate. That's what you need to submit by Friday midnight. Question?
I know that I think in one of your messages you said that for the certification we should use our school email. I don't know if that was just for the code itself.
So this is what happened when we were last here. So the good news, so let me try and clear this up, is at the top of our course site, Bloomberg has given us a benefit which other people don't have through the web. And you can get to the web here. And by the way, it's the same login. So if you create a login on the terminal for BMC, you can use that on the web to access it. But you got to register. So here's the point. It normally costs $149. But if you meet 2 criteria, if you have a umd.edu email, so whatever at terpmail.umd.edu, register with that email, right? And you type in that code, it'll take the $149 web fee and make it 0. And so you can actually do the entire certification through the internet and not be in a terminal. Or you can work back and forth between the two. Okay? But if you don't use a UMD email, and if you don't type in that code, then it's going to say $149. Don't waste your money. Now, you don't have to use the internet. You can do it within the terminal. That was the original plan. But Bloomberg was being nice to us, and they created it so that anybody with a UMD email, that's like other students can't do it because they won't have a umd.edu email, can't get it for free on the web. So they're giving you the $149 for free. But whether you take it online or whether you take it through the terminal, you got to do those 5 sections. Okay, 5 sections, above 70%, and a certificate by midnight Friday. Homework 3, 10 a.m. Monday. No class Wednesday. Okay, now final point, because I'm going to leave the lab open for certification as well, whether you take it online or not, it'll be here, is that over the weekend. So unfortunately, the school made a determination that they don't want students in the weekend above the 2nd floor because they don't want to staff, for security reasons, only the 1st floor. They want to staff the upper floors to monitor. So this room is locked every weekend. And what they're worried about is nobody's going to take the crappy PCs, but they have stolen the monitors in the past, and they've stolen the keyboards for some bizarre reason. But so long story short, the room's going to remain locked, and the school is not going to provide support to unlock the rooms for the rest of the semester during the weekends. So as a compromise, because I told them about our class, is that they gave swipe access to the door in this room to my 3 TAs. And what the TAs are going to do is they're going to coordinate to open up this room on the weekends. Now, let's talk about what that means. That they'll swipe and the door will open, but once they leave, their swipe card is gone, and if you're not in the room and the door closes, you are completely locked out. Okay? So, but once you're in the room, you're welcome to use the room, and you can let each other in. Okay? So we're not going to widely advertise that this is available, but nonetheless, the TAs are going to make it available so that you can try and look for their announcements when they'll at least meet a few people here to open up the rooms. So if you happen to walk out and you prop open the door a little bit, just remember to close it later when you do leave, because I mean, seriously, people unfortunately will come and steal stuff in this room, right? And so right now we're getting a break, and they're letting us have access to open the room for you guys. We're not publicizing it to the rest of the school, so you are unique. So I wouldn't start telling all your friends about it that, hey, the Bloomberg lab is open in 3505, because I'd like to restrict it to the students that are in this class, because really we're the only ones that are going to have access to it over the weekends. So look for an announcement from the TAs on when it's open. All right, any other questions? Yes, sir. That's supposed to be open in the weekends. I just asked them about the hours. First one. All right, everybody have a good rest of the week. No lecture on Wednesday. See everybody a week from today on Monday. Sign. So I just want to stop the recording. Today, September 9th.